Harsh, thank you so much for joining us. My first question to you is, what does an investor do now? We've seen stock prices increase significantly. There's been significant amount of money coming in through the SIP route into the markets. For a mutual fund investor who's been invested for the last 24, 36 months, what should he be doing now?
So I think the money that you put into equities, and definitely what you put in through a SIP route, is money meant for the long term. And in the whole advantage of putting money through the SIP route is that it is able to take care of peaks as well as valleys. So the best thing is to do nothing, I think, because you don't need the money now, you're going to need the money later. Obviously, when stocks are, even if we assume that the stocks are expensive, you're getting less of the stocks when your SIP amount remains the same. And you will get more of the stock if the price, for example, falls. If this makes you nervous, I mean, some investors get nervous when the prices increase as well. The only change that I would suggest, if at all, as I said, the first recommendation is no change. The only change that I would suggest, if at all, is to look at your asset allocation. If you've got into it with planning, you have a certain allocation for equity, and you had assumed a certain return. So you had assumed that at the end of a certain period, your equity will be a certain percentage, your debt would be a certain percentage. If because the prices have risen, you find that equity has outstripped what you wanted it to be, to that much extent you shift it to debt. Otherwise, the answer is do nothing. And this allocation is something you should do whether prices fall or prices increase.
Okay, so let me flip this and ask you another question. So what if somebody wants to enter the market at this point in time? I mean, either through the SIP route or wanting to make a lump sum investment, and when prices are at these levels, what would you say to him?
So again, if you want to enter the equity market, I would not recommend a one-shot entry. Don't try to time the market, right? So which means that enter it through the SIP route. A possible entry could be in something like the dynamic funds, which regulate the percentage of equity and debt based on some kind of a pre-decided formula, which is not dependent on fund manager discretion. The proportion of debt and equity is not dependent on the fund manager discretion. They obviously actively choose the equity and actively choose the debt, but the proportion is decided as per a formula, pre-decided formula. So that you have primarily equity funds like dynamic equity funds. You have what are called the balanced advantage funds, which are extremely popular currently, where on an equilibrium basis, I think the equity would be about 65-70%, but currently a lot of them, the equity proportion is about 44%, 40 to 45%. Then you have the equity savings, the dynamic equity saving products, where again the equity percentage currently would be around 20-25%.
Okay,
all these three categories are treated as equity funds because they have a balancing figure as arbitrage. I think if you want to make a lump sum investment, if at all, I would say spread it over at least 6 to 12 months, and even then, you do it to a dynamic fund or a balanced advantage fund or an equity saving fund, depending on your risk profile.
Okay.
Through a SIP, any time is a good time to invest in tech. So I think as long as it's a long-term SIP, today is as good a time as any.
Okay, so I say one final question. You alluded to arbitrage funds. What about those guys who have stuck with some of those funds that have not performed? Would you suggest now is perhaps the time to switch and perhaps park some money in arbitrage funds? Is that a right strategy?
So you're talking of equity funds that have not performed. So if I'm in a fund that has not performed, then I think how you look at non-performance would really depend. I mean, I would not choose a fund as a non-performer simply because it has, say, not performed in the last 1 year. you should take a slightly longer term view of equity funds. Maybe at least take 3-year moving averages over 5 years. That is the least that I would take, because equity performances take time to play out, and just taking a year's view may not be correct. If you have done that and you want to shift equity, I would shift directly to equity. Why pass it through arbitrage? There is no real advantage of passing it through arbitrage unless you want to reduce the extent of equity, in which case, obviously, you first reduce it from quote unquote non-performing equity funds.
All right, Mr. Roongta, we leave there. Thank you so much indeed for joining us with your views. That's the view of a financial planner. He's saying stick to equity funds, keep the faith in mutual funds despite the run-up that the market has seen.